Some investors are all about doing heaps of research on the companies they invest in, knowing all the numbers, and they are really active in every single investment they make. Some want to take a completely passive approach and just buy index funds or let other people manage their money. But many people would love an option that falls somewhere in the middle, a process that is easier than full-on value investing, but still gives you a degree of personal control over your portfolio. If this middle ground sounds good to you, the magic formula just might be the answer you've been looking for. In today's video, I am going to walk you through magic formula investing step by step with all the good practical information that you need to know. And I am going to share with you our personal investment plan as well as our tracking spreadsheet. And I'm going to share with you the companies that we have in our actual portfolio. Hi, if we haven't met, my name is Sam and our channel is all about achieving wealth and financial freedom through a three-part strategy: earn more, spend less, and invest the rest. Before we get into the how of magic formula investing, we should talk about the what. What is the magic formula? It's an investing process developed by Joel Grenblatt, and he describes it in his book, The Little Book That Beats the Market. Grenblatt is a billionaire hedge fund manager who also teaches at Columbia University, and he's well known for being a value investor. Put simply, value investors believe that if you buy good companies at cheap prices, then in the long term you will do well. And this is the core principle that the magic formula is built on. What makes it different from the traditional method of researching and valuing individual companies is that the magic formula is a systematic method that screens stocks using value metrics in order to rank them, ultimately giving you a portfolio of about 30 companies to invest in. Investing with Rose put it in a really clever way. She said that if Warren Buffett and index investing had a baby, it would be the magic formula. And I really like that. Thanks, Rose, for the good quote. What I like about this approach is, number one, it is self-directed, so that means you're not going to have to pay management fees. Number two, it is a really simple system, so somebody who is new to investing but still wants to take a value investor's approach can easily implement this process. And number three, it is systematic, which means that when you follow it, you are going to remove your emotions and you're biased, which could potentially kill your investments. Moreover, extensive backtesting shows that this method outperforms the market in the long term, and I'm talking like a 20-year time horizon. Which brings me to a really important thing that you need to know about this approach to investing. In order to see the benefits of this process, Grenblatt says that you need to do it for at least 3 to 5 years. Like with all value investing approaches, this is a long-term strategy. You might not beat the market in the short run, and especially in times like these where the market is really euphoric and bullish, but the success of investors like Warren Buffett shows us that eventually you do beat the market in the long run. Remember, value investing is a marathon, it is not a sprint. Okay, let's talk about the how. How do you do it? First things first, we are going to identify our companies, and luckily Grenblatt has made our lives easy and we can just head right over to his website, www.magicformulainvesting.com. Once you complete your free registration, you can use his calculator, which will automatically generate the results using his formula. All you have to do is set your market cap and the number of companies you want to generate. Grenblatt says that a market cap of 50 to 100 million is suitable for most people. Now, the bigger the market cap, the larger the company in terms of value as determined by the stock market. Typically, people say that investments in large cap companies are more conservative than investments in small or medium cap companies, and that they potentially pose less risk in exchange for less aggressive growth potential. So if you want, you can even set your market cap to 10 billion, and then your list is only going to generate what is known as large cap companies. To build our list, we chose 500 million for the market cap because it aligns with our risk tolerance and the long-term outlook we have for this strategy. We also chose 30 companies because Grenblatt says that any real benefit from diversifying becomes negligible with more than 30 companies. Click Get Stocks, and there you go. Boom, baby, we have our 30 companies. Side note, look at this disclaimer. I love that he has to tell people that it's not real magic. I hear this is where you go to learn the magic investing. Wait, it's not real magic? If you don't want to use the website and you're keen to do these calculations yourself, I will link an Investopedia article below that explains the process of calculating each company's return on earnings yield and return on capital and then how to rank them. You could also buy the book and follow the general screening instructions. I trust the results of the website, so let's pull up our spreadsheet and start populating it. You can see that I'm typing the ticker symbols. The only bummer about this website is that you can't cut and paste. It stinks, but he did give us this calculator for free, so overall I feel like it's a reasonable trade-off. Now we need to decide the total amount that we want to invest in our Magic Formula portfolio and map out our purchasing plan. And here's where paths can diverge, potentially, depending on your risk tolerance and how systematic you want to be with this process. Strictly speaking, in the book, Greenblatt instructs us to break up our stock acquisitions into multiple stages. However, on his website, he says, if the amount you are investing represents a large percentage of your long-term investment portfolio, you may want to consider making multiple portfolio purchases over a 12-month period. So to me, that indicates that buying in multiple stages is optional, and since this is a tutorial video, I'm going to show you both ways, and we are going to start with the multiple purchases approach. The book says start by picking 5 to 7 companies from the list to buy, and that you should only use 20 to 33% of the total amount you have allocated to invest in the first year for your Magic Formula portfolio to buy those 5 to 7 companies. Then every 2 to 3 months, you repeat this process to buy more and more stocks until you have used all of the money you intended to allocate to your portfolio. After about 9 to 10 months, you should have a portfolio of about 20 to 30 stocks. And if I was going to do it this way, this is how I would apply his guidelines. Chris and I feel comfortable putting $30,000 into our Magic Formula portfolio, so I'm typing that right here. I want my portfolio to have a total of 30 companies, and I want to follow the rules while keeping my math as clean as possible. So I would buy 6 companies at a time. That means I'll need to do 5 rounds of purchases to get the total of 30 that I want. I'd make my purchases every 2 months, thus it would take me 10 months to build my portfolio. I'd also align my percentage allocation to the 5 rounds, so I'd spend 20% of my total allocation amount during each purchase round. In other words, that is $6,000 for 6 companies. I'd distribute my allocation for each company evenly, meaning that I'd invest $1,000 into each company. Aren't those numbers so cute? I just love a good clean calculation. Mwah. So if you decide to space out your purchases, you're going to have to make some choices about what companies to buy at which stage. But remember, the whole point of this system is to remove our bias. So if you start doing something like, oh, I'm going to buy the 6 companies that I'm most familiar with first, you are adding your bias back into this process. And when you do this, you are running the risk of throwing off the groove of the whole system.
Ow! You threw off my groove.
I'm sorry, but you've thrown off the Emperor's groove.
You were saying?
So my instinct is to just buy these in descending order and group them like this, adding the 2-month date spacing so that I know when to set my calendar reminders to make these purchases. Okay, now let's circle back to the other approach, which I'm going to call the one and done. Rather than spacing out our purchases, we are going to buy shares in all 30 companies in one go. It looks like this. We have $30,000 to invest, spread evenly across 30 companies, so that $1,000 allocation stays the same. The only thing that changes is that I'm going to buy all 30 companies today instead of spacing out the dates like I did in the other example. The process is really simple, and even though it's going to take me some time today to sit down and buy all those shares in one go, in the long run, this is going to save me time because once I'm done, I don't really have to think about this portfolio for about a year. And this is the technique that Chris and I are going to be using, so as we keep you updated on how this portfolio performs, I want you to know exactly what we did to start. So we decided to go with this approach for a few reasons. Number one, ultimately, I think this is going to save me time in the long run. Number two, it is completely eliminating the possibility of me putting any emotions into this investment. And number three, our Magic Formula portfolio actually represents a very small percentage of our overall stock investing portfolio. So we are comfortable with any kind of risk trade-off in exchange for the other benefits that I've just listed. Okay, now that we know all this, we can start pulling data from the internet and using our spreadsheet to figure out how many shares we can buy of each company in alignment with our purchasing plan. I'm going to find the current prices that these companies are trading at and start importing that information into my spreadsheet. And I do this by quickly looking them up on Yahoo Finance and cutting and pasting them into my spreadsheet. Watch me go. Remember, if you are splitting up your purchases, you only need to pull data for the stocks that you are planning to buy today. Now we can figure out how many shares we can buy. As you remember from the breakdown of my purchasing plan, we have $1,000 to spend per company. All we have to do now is divide 1,000 by the stock price, and that tells us how many shares to buy. Remember, you can't buy a fraction of a share, so we are going to round to the nearest whole number. Then we go to our brokerage account and buy them. And since we like to keep accurate records of our investments, we complete this column to know our exact amount invested. And again, remember, if you are breaking up your purchases, only buy the ones that you have decided to buy for this round. And we're done for today. Now, if I was going to space out my purchases every 2 months, I would then set a calendar reminder for myself to make sure I knew when to buy my next round of 6 companies. And I would continue to repeat this process over and over again until I reached the 30 companies that I had originally intended. But since I bought all 30 of mine today, I just get to chill. There's a really important part of this process that we haven't talked about yet, and that is the selling. So Grenblatt tells us that we need to hold on to these shares for about a year. And just before the year is up, we need to look at our portfolio, check on all the current prices, and figure out if we are going to have losses or profits for each of our positions. For the losers, we need to sell them just a few days before the year timeline has expired. And for the ones that are going to be winners, we want to sell them just a few days after the year timeline has expired. And we do this to take advantage of capital gains tax. And once we're done doing all of our selling, we go back to the website, back to our spreadsheet, we recalculate all of the numbers, and we do it all over again for the next year. And it's really important that in order to get the benefit of compounding returns, you need to reinvest whatever money you have made in the previous year to fund next year's Magic Formula portfolio. Just leave the money in there and let it roll over year after year. All right, everyone, that's it for me. Whew, this was a long video. Thanks for sticking around. Don't forget to like and subscribe. And if you have time, check out these other videos. I think you'll like them. Thank you so much for watching. I'd love to hear from you in the comments. Remember, earn more, spend less, and invest the rest. And I will see you next time.